Today I want to discuss an Iron Condor, what it is and how to enter it. The market may open here in a little bit, so my chart may start to jump around. Basically, an Iron Condor is a put credit spread and a call credit spread. You put those together, it's called an Iron Condor. You get more income because you're selling two spreads, but you also have risk on the top and the bottom, which is the negative to it. A lot of people will trade these in low volatility environments because if you just sell a put credit spread, because volatility is low, you're not going to make that much. Or if you just sell a call credit spread, you're not going to make that much. So if you sell both, you're bringing in additional income for the same amount of risk, although you do have risk on both sides of the trade, the puts and the calls, as opposed to just a directional trade. I prefer it in a little bit higher volatility environment because I would prefer to sell my credit spreads because, again, you're selling options and you want to sell options when volatility is high. So I prefer to sell them when the volatility is a little bit higher and then hope for a volatility drop, and that will help me make money on the trade, even if it doesn't move. I've used it at different times, so you could do either one. You do need a stock that has fairly liquid options. That helps you not only in entering, it also helps you if you have to adjust and when you get ready to exit. If you have wide spreads on the options, it can be a lot more difficult to get in and out of the trades. There are a couple of ways that you can set your Iron Condors up. First of all, when entering them, you could enter it as an Iron Condor trade, or you could enter the put credit spread and a call credit spread as separate orders. I actually prefer to enter the separate orders because I found that I get better fills. Now, if you're trading something like SPY or QQQ, then it probably doesn't matter because the spreads aren't that high. But the spread can be your enemy in any options trades. You have to be very careful with that. As far as picking what you're going to sell, my video is really not about support and resistance. It's just about the Iron Condor. But you see I have a weekly chart here. I trade my Iron Condors at 30 to 45 days out. You could go further, but that's typically where I trade them. And I use a weekly chart because this is a longer term trade. And about the only moving averages I use are about a 50 and a 200. If I was going to enter it based on price levels, this is the chart I would use to try to pick what price levels I think there would be support. And it's an eyeball thing. I just look at it and it looks like I've got support around 140. It's also a whole number. And they got support again at 130. Same thing. There's a lot of bouncing through here, bouncing at 135. On the top side, probably 160, 155 area, all the way up to 170. You could also draw some trend lines and try to determine where you think good spots will be if you want to do it based on the chart. But if you're going to use trend lines, you're going to use price levels. Also remember, because it's an Iron Condor, so you want to be above that. So if you determine that you've got support at 140, then you probably want to sell the 135. Put credit spread down here to start your Iron Condor, or even the 130 if you can get a decent enough return. The other way to enter these is based strictly on delta, and I tried to be in the 10 to 20 delta range when I start these contracts. So here, I could sell either the 135, 130 puts, or I could come up here and sell if I wanted to be around the same delta. That was a delta 12. So if I want to get down to a delta 9, we'll say it would be the 170, 175 that I could look at selling. Again, if I'm just strictly basing it on what the deltas are, I could do that. So what I want to do is I'm going to go ahead and set this up. I'm going to set it up as one trade as opposed to two separate trades. So I'm going to go ahead and do a sell Iron Condor. And remember, you could do this as a put credit spread and a call credit spread. I'm going to start at this 12 delta here, which would be the 135, 130. And I'm going to come up to the 9 delta here, which would be the 170, the 175. As far as how much room you want between your strikes, it really depends on what you're trading. For Apple, I like 5. You could bump it to 10, but again, that's where your risk is the length of this strike, the 135 minus the 130, which is 5, minus your credit. and your credit is 72 cents. So let's take a look at how this trade looks, the diagram, the risk diagram on it. You can see if everything goes perfect, you're going to make about $72, which is anywhere between 134.27 and 170.65 or so. If it goes past that, you start to lose money. The most you could lose on this trade, excluding your commissions, is $428, which is, we'll lock that in so to quit changing. So is the most you can lose, which is basically the distance between these strikes minus this credit. Now, when I enter an Iron Condor, I will typically put a closing order in for about half of whatever credit I get. So, you know, the 72-cent credit, I'd like to have closer to $1, to be perfectly honest. So let's look back over here and see what would happen if I went to this 18 delta. Be 165, 170, so unlock that. Okay. So now I've got $1.03 in credit, and my max loss is $3.97 because, again, the 5 minus the $1.03. So that's not bad. Yeah, I like that pretty well. Little concerned that my upside here is not that far away. You know, I can change the date here to get an idea of what the expected move is. See, now you can see that my expected move could be past where my loss is right here. So I'm not sure I like that. But let's take a look at the chart again, and let's see. Obviously, the market's opened up, so I probably need to adjust this. This is going to change all my numbers. Let's go back and reopen this. There we go, $1.16 now. Let's go ahead and move this back up to 170 and 175. See what we got, 76 cents. But see, now I'm within the expected move for the trade. Let's look at the chart. Let's see, I'm at 170 to 135. So that means my break-evens are going to be about right here and right here. So the second thing I want to consider is, what do I expect the overall market to do? What is the market doing now? Now, truthfully, the market's up right now, and it's been in a downtrend. So I have concerns that this may retrace back down into this area. That means that I could move this call credit spread down a little, assuming the market's going to go down. And if this is a standalone trade, I probably would not do that, because right now, you know, I'm fairly delta neutral. You know, I'm a little bit, I've got a delta of -2, which means I'm a little bit, you know, long here. I mean, short here. So I need the market to come back down in order to make the money I need to make. Because I'm being negative delta means I'm short this stock overall, or short this position. So I needed to come back down. But let's assume I go ahead and take this trade, and I take it at 79. So now I'll probably set a good to close order at around 38 cents. Now I make $38 on a $421 risk. So that's a 9% return on my money. And as far as annualized, it just depends on how fast I get in and out of it. If I'm in it for, you know, if I'm in it for a week or two, that's actually a very good return. If I'm in it for the whole 45 days, it's still going to be a 9% return. It's just not as good from an annualized standpoint. In most of my trades, I look at, you know, annualized gains. As far as adjusting these, I'm not going to do it. The video is really not on the adjusting. You have a couple of choices. You could simply say if it breaks this 170 or if it breaks 135, you just close it. And if it did it today, that'd be a $125 loss. That changes with volatility, and it changes with time. So if you stay right here in the center, and then 30 days from now it moves to right here, then your loss is probably going to be about half of that, because the time is coming out of it, and there's not as much time for it to make a move either direction. So it's, you know, that's just if it came down today to these levels, it'd be approximately 156 up here, 124 down here is approximate loss. If volatility were to spike, then these numbers go up, but because the short options are worth more, and your longer options won't offset that volatility as much because they're further out of the money. So you could just close it. The other option you would have, if it's moving up into this area, you might roll these up for a credit. You could roll these puts up to, say, the 140 to 150 range. You just have to see what credit was available, and that's going to depend on time. Or you could roll the whole position. You could. This is 45 days out, so you could, let's say 30 days has passed. There's 15 days left on this. It's pushing this up here. You could roll both positions out to for another 45 days. Pick new strikes. Make sure you get a profit, a credit, because you always, anytime if you can't roll for a credit, you should just go ahead and close it and take your loss. You never roll for a debit. That very rarely makes any sense. And that's how you would adjust these if you don't close for the profit. But Iron Condors, I like them. They have their place. I don't trade a lot of them simply because I like strangles better. They're more profitable over the long term, and I can get further away. I've had much better luck with strangles as opposed to Iron Condors. But the big difference between a strangle and an Iron Condor is Iron Condor, you have fixed risk. The most you can lose on this trade is $421. On a strangle, if Apple were to drop 50 points down to 100, you see on the Iron Condor, you still only lose $421 if you do nothing. On a strangle, if it dropped 50 points and went down here, I'm going to lose $5,000. It could lose more if it kept going down, and the same on the upside. If this were to go up to 200, the most I'm going to lose is $421 on Iron Condor. On a strangle, I'm going to be down about $5,000 roughly. So that's one thing you have to keep in mind, the difference between the Iron Condor and a strangle. A strangle is a more advanced trade, and it has unlimited risk, where an Iron Condor has a limited risk. The most you can lose. This is all your buying power is going to be $421 on this trade. On a strangle, when you enter it, I'm going to guess it's going to use about $2,500 of buying power. So it uses more buying power because there's more risk. And as it moves up or down toward your shorts on a strangle, your buying power that it uses is going to increase. You have to make sure you have excess buying power in order to absorb that, or you could get a margin call. On the Iron Condor, this $421 of buying power is all it's ever going to use. So it does have advantages. They're a little harder to manage than strangles. Not quite a high profit percentage in my opinion. As I said, I rarely trade Iron Condors anymore. I used to. It was one of my go-to trades. Because I have a larger account, I just prefer the strangles now. But if you're just starting out and you have a smaller account, Iron Condor is going to be a good way to build your account and learn about trading. I certainly recommend them as a beginning trader or someone that wants to take limited risk, or just as a addition to your normal trading. If you have any questions, let me know. Put any questions or comments you have down below. Please subscribe to the channel and like this video. Thank you.